Well, Rupen Rajguru, who joins us of Julius Baer. Hi, Rupen. Always good speaking to you. What are you making of this move? India standing out. We're not cheap, but yet we continue to move higher. Do you think on the index itself, we're nearing the higher band?
Yeah, hi. Afternoon, Nigel. And, as they say, market always, surprises both the optimist as well as the pessimist. And right now, probably market is surprising the optimist as well. So, this year, if I were to just put it in a word, India, at least as of now, appears to be decoupled. I know it's a very widely used term, but both from the earnings growth perspective as well as from the economic growth perspective, India is an outlier in the global context. So while India weathered the storm of relentless FPI outflows for the first 7 months of the year, in last month or rather 5-6 weeks, what we have seen a heavy influx of FPI inflows, and hence typically the FPI gets into a larger caps or buying of the index, or it might be ETF money, and hence now we are seeing the index scaling, probably not exactly a lifetime high, but it is inching towards that. So at this point of time, purely from a fundamental perspective, definitely I don't see a big upside, because at say 21 times next year's earnings, we are not cheap. But the technicals and liquidity has its own role to play. So, but at this moment, as Ben Graham has said, that a realist will sell to an optimist and buy from a pessimist.
But it's optimism all around, Rupen. That's well said, and aptly used, that phrase. But even companies that we speak to, right? I mean, forget what market participants think, but companies generally, there's a fair bit of optimism about future prospects, etc. Maybe the only dark cloud is that across a range of industries, and I think it's very well known and well accepted, that lower priced or entry level segment is not doing too well. I mean, in some cases it's doing badly, but the premium end is actually growing very, very well across the board. I'm talking about consumer sectors, but I mean, that would flow through in financial services and other things as well.
No, you're absolutely right, Prashant. And in fact, last week, we met probably close to say 30 odd companies across sectors. And I think at a broad level, 2-3 key standout themes. One is, there is no demand destruction, in the sense the fear that there would, because of high inflation, there'll be demand destruction. So absolutely demand. Nobody complained that there is lack of demand. A second theme, I think, which is probably we'll see more often, the rural recovery is also pretty strong. Some of the collection efficiency in rural India is like almost 97%. So that again is a very strong number. And I think today one of the leading brokerage house spoke about MFI industry, which is a beneficiary out of it. And thirdly, as you rightly said, the premium segment doing exceedingly well. So the top 5 or 10% of India, which as they say, India, there are like 5% of India's earnings is per capita is closer to Europe's per capita, and I think that segment is doing exceedingly well. So you are absolutely right. There is no issue as far as the demand is concerned. Why? Overall, there is a good amount of optimism. The festive season, I think all the companies, including the automobile companies, are very, very optimistic at. So yeah, that's the right now all-round optimism. But as they say, how much of that optimism is in the price, and that's what we have to be cognizant of.
Okay, all right. Rupen, I was reading a couple of notes today with regard to diagnostic as well as hospitals. I know for the last few months, in fact, the street is coming to terms with maybe the best is behind them. Maybe, in fact, margins will compress from here. Competitive intensity is likely to go up. What's your view on the space, the diagnostic, the hospital theme from here on?
So, both are part of the India domestic story. And look, from a diagnostic perspective, if I were to take it that first, the big theme there, and I think one of the reasons why we like it, it's a play on shift from unorganized to organized. While the competitive intensity has gone up, Last year, they had a very high base because they had that one time of COVID-related testing which happened, which bumped up their revenues and which market gave an even higher valuation to that revenue, which were not sustainable. And this year, the reverse has happened. That revenue has neutralized and the pricing have gone down. From here on, that big theme remains. So we remain positive on that theme from a 3 to 5 year perspective. The ROCs have come off, but we believe that's just a passing phase and it will again pick up. So we remain optimistic on that theme. Coming to hospitals, while hospitals, again, there are, we look into those hospitals which, big amount of capex is already done. And I think that a lot of these hospitals where the capex is done will be a big operating leverage play. So the return of medical tourism and also people doing the elective surgeries which they had postponed during COVID time. So that will come back. So we don't see any reason to see any slowdown there. So we, in fact, are positive on both of the sectors.
Rupen, do you like any of the capital market plays? I don't know if you heard or you were listening while our colleague Yash was presenting some data on the opportunity the depositories have because of the insurance dematerialization. It's actually almost like a new market segment opens up, right? So it's so far only stocks, but now insurance also in a dematerialized form, and could at the rates which Yash mentioned per policy could be a pretty large opportunity.
No, absolutely. There is a big scope and big size of opportunity out there, and we have to say how this entire insurance dematerialization plays out. But all these capital market intermediary, and as I would call them, they are rent seekers because their revenues are also linked to the transactions which people do. So there is a bit of cyclicality. While there is an annuity aspect of the business, but there is also some bit of cyclicality as well involved in those businesses. So while from a 5 to 10 year perspective, definitely those are the good segments to be in. But right now, what's happening is, again, some of these companies are trading at a valuations. Whilst they have seen some corrections, but we would wait for better entry pricing in these capital market intermediaries.
Okay, all right. Final question then, Rupen, before we let you go. Cement, it's seen a good bounce back. You believe it's good for more? And also, what's your take on the real estate space? Both of them normally go hand in hand as well. Do you think the best is yet to come?
So Nigel, interesting question, and real estate is part of our big theme, wherein we are clearly seeing, beginning of a real estate cycle, and the fortunes of cement is closely linked with the real estate cycle. So on cement per se, we saw last quarter, in fact, this quarter also, there would be pressure on as far as input pricing is concerned. But despite that, the quarterly numbers, that is the first quarter numbers, were quite strong. And in fact, that's why we have seen a big recovery in the cement stocks. So as a theme, what we believe over the next 3 years, the overall demand for cement will outstrip the supply. So we expect the demand growth at a country level to be upwards of 8% per annum for next 3 years on as far as volume is concerned. Probably supply will grow by 5%. So that, and hence, which is augurs well for the overall pricing of the sector. So while now the input costs have come off, we have seen the petrol prices, coming off significantly, and so we will see the margins, especially from the December quarters, the EBITDA per ton will go up. So we continue to like the cement space, and historically, pre-election, 18 months prior to election, the general election, we see a lot of activity on the infrastructure side, which augurs well for cement as well. And on the real estate, as I said, we are 1.5 years into this cycle, and typically the real estate cycle lasts for say 6 to 7 years. So we are probably not even in the middle of the real estate cycle, and I think all the numbers what we are seeing, be it the registration numbers, are pretty strong. So we are positive on the real estate space as well.
All right. Well, good speaking to you, Rupen. Thanks so much for joining in and sharing all those thoughts. Positive on real estate as well as the cement theme.